The goal of every Friday show is to wrap the week, and that's where we take a step back to the 30,000-foot view of what has changed from Friday to Friday. Before we get there, I did want to start with a poll question. We asked you recently, where does spot gold close on December 30th, 2020? So essentially year end, where is gold and where does it close? As a frame of reference, right now I'm looking at the gold index. We're right around 1916, 1915 as of yesterday's close. So 37% of you, the most popular answer was between 1800 and 2000, which is essentially where we're at. This is the range that we've been in really for the last 3 months. You know, gold had that big rise into the peak in early August, peaked about a month before stocks did, and since then it's been in a stopwise move, and so far gold has found support around 1850. So over a third of you saying we remain in that range. 31% say over 2000 to 2200, which would be retesting or even pushing above previous highs, and 19% of you said above 2200. So what's interesting to me is almost exactly half, 50% of you said basically above 2000, which means we break above, looking at the chart, break above that that swing high from August and September. You know, the gold topped out just below 2100, came down to the upper 1800s, rallied back just above 2000, and basically over half of you are saying we're in this, you know, range, which is materially higher from here. You know, I didn't answer this question, and I should note, you know, 14% of you said below 1800, which would be that's a pretty big move, although it's not that far away from here. Assuming that would be year end below there would be pretty severe and put us back to the levels from spring of this year. If I had to answer, I would probably say 2000 to 2200. I wouldn't be surprised if we fluctuate a lot in these general areas before we appreciate, you know, over the next 3 months in some way. But interesting to hear some optimism on gold. Hopefully you've been paying attention. We've been talking about the long-term setup in gold, which overall is still, I think, one of the more constructive long-term charts. If you look from bottom left to upper right over the last couple of years, it's been a decent uptrend for sure. You know, in terms of what's happened, we'll talk a little bit about today's trading. I just want to focus on sort of the weekly change. I'm going to refresh this chart just to lock in today's closes. Sorry, the labels are a little off given some adjustments, but overall, here's where we're at. The S&P finishing the week around 1.5% higher, 1.6% really. The NASDAQ with today's pullback essentially was one of the top performers, came down below and was up only 1% over the period. Things that outperformed stocks this week: gold was up 2%, emerging markets were up almost 2.5%. The big winner this week, though, was small caps, up 4.4%. And again, the biggest, most impressive gain, if you look, pretty much everything was down today except for the dollar and small caps, both of which found a way to chip higher. So there might be a signal there for sure. In terms of what underperformed the S&P, we mentioned the NASDAQ up only 1%. The dollar was down 0.7% in the form of the UUP, the dollar ETF. Bonds in the form of the TLT down 1.3%. Bitcoin down 1.6%. Crude oil, really the big loser, down 7%. Let's look very quickly at just how things played out here on Friday. As I mentioned, obviously we're here on the West Coast, and so the news of the president coronavirus positive signal came in the evening for us. It was about 10 p.m. I want to say when I saw it, and so I ended up staying up for a while looking at long-term charts, thinking of ramifications. And my poor friends on the East Coast, I saw them still up tweeting about it and everything. So I'm sure we're all feeling the pain of lack of sleep right about now, given when all of this came out. But, the futures dropped pretty quickly, which is understandable. When there's uncertainty, that's usually the reaction. But since then, that was pretty much the low. We opened at the lows of the day, retested those, and around lunchtime, it felt like this could be a big push lower, but it recovered pretty well. The last 30 minutes came off a bit, but overall, stocks held up much better than they could have. We could have digested that news in a much more negative way. The S&P just finished down 1% today. I think the big story, though, small cap and mid cap finished really essentially toward the highs of the day. The NASDAQ really drove things lower. So a bit of a change of character from what we've normally seen. If you look at the sector rotation, real estate and utilities, number one and number two, those are both up on an absolute basis, 1 to 1.6%. In terms of what did not work, it's the flip side of what we saw yesterday: tech and communication services at the bottom of the list. So, at a time when it felt like tech is regaining its footing, and all of a sudden it's the return of the mega cap tech trade, sort of what we've been used to for a while. I think, a day like today with the news that we saw and the reaction This tells you how technology, communication services, even healthcare, how they can react to some negative news or certainly an increase in uncertainty. Just very quickly, bonds finished a little bit lower. The dollar a little bit stronger today, as I mentioned. Gold and silver were essentially flat going into the close today, essentially chopped around the midpoint. Let's get to our Mindful Investor Live chart list and really the purpose of a weekly chart routine. And as we've talked about many times, I find routines are incredibly important. As I've hopefully, as you've heard me say, I think a consistent, imperfect routine is light years better than a perfect but inconsistent routine. It doesn't matter if you have the best charts ever. If you don't use them in a consistent and repeatable way, you're really not, you're not serving yourself well in terms of your ability to synthesize what you see in the charts and apply them in a consistent way to help you perform better. So this is part of my weekly routine, which essentially starts on Thursday and ends on Monday. And it starts with a look at macro charts like this and starting top to bottom. Let's see how many we can get through during this Wrap the Week segment. So number one starts with our weekly market trend model. Our long-term market trend model has three components, and we've gone through this before. If you're not familiar with this, go through some of our previous Friday shows. I'll talk in a little more detail. The long-term trend has been positive since June, remains in place because the 21 and 34 week moving average exponential averages are still in a positive configuration. The really interesting stuff is down here at the bottom. So the medium-term trend for the last 2 weeks has been really close to switching below the zero line. And if we'd seen more of a sell-off, I started to think today might be the day where, the week where you actually get a negative signal. We didn't get it though. And the market had rallied enough before today to keep this trend positive. And this is based on the traditional weekly MACD or weekly PPO model. And when we get across down there, that would be a sell signal. Last sell signal we got was in mid-February, just as we had that first big leg down. And so that's certainly something I'm looking at as I'm thinking about the potential for further downside from where we're at now. This short-term trend is just looking at the price relative to the 5-week exponential moving average, just barely closed above it. It looked like it did, so I switched this positive, but it's essentially right flat at the zero level, given where we closed today. The daily chart, we've been talking about this movement between 3,200 and 3,400. And one of our questions is going to get in a little more detail on this idea, but this is sort of the framework that I see us at. I usually think of price levels, support and resistance levels on the daily chart in terms of lines in the sand, right? You'd expect support at a certain level. If we break it, that tells you the momentum is enough to push us to the next level. And the same on the upside. So right here, if we were able to close above 3,400, follow through to the upside, which would take us above those swing highs, that first reaction off of the pullback in early September, I think that would clear the way to 3,600, if not more. And it would not be surprised for us to get that at some point. This, the way this week played out is we basically have come off of that support level, which we identified from back here. We've now tested the resistance level we've identified from back here. We're back below the 50-day moving average, so we did not get the follow through that we would have wanted today. If you're optimistic for further upside, I think we're still very much established in that range. So I think at this point it's still a binary outcome. We break above 3,400 or below 3,200, and that's the trend to watch. Given what I'm seeing across the board with breadth characteristics and overall potential weakness, my base case is that we go below 3,200 and we find support further down. But again, I will not clear the way for that signal until we break down through the new lows. But at this point, lower highs and lower lows are the tactical time frame. Continuing on, this next chart is one we refer to pretty often. This is one of the main ways I'll look at breadth. We have a couple reads that we'll make on it, but essentially it's the cumulative advanced decline lines for some of these different cap tiers, and they're color-coded red. One is in orange here, the S&P one, which is essentially flat here recently, but the rest of these certainly more negative with lower highs and lower lows. Potentially, I think this would change more neutral if we were able to break above that swing high from earlier in September. This is not updated for today's close, and this will most likely come off a little bit. So I still don't think that will happen now. I think going into next week, we'll have continued downtrends on each of these advanced decline lines. And again, overall, I would be much more comfortable being bullish on the market if these lines are sloping upwards, because that tells you that stocks are managing to close higher than they were the previous day and have build up that trend over time. We're not seeing it right now. We talked about this, and I feel like this is one of our 3-and-3 charts recently, which is basically looking at the new highs list. If you look at the new highs now versus the new highs in mid-July, I think that's the difference, or what you would be looking for. If you are expecting this sort of tactical pullback before the next leg higher and we're moving up to retest highs, you would want to see an increase in the new highs list. And at the most, this got to about 10% of the S&P on a given day, making a new 52-week high. We're nowhere near that. We're still in a handful of stocks on a good day. So we haven't seen enough stocks like home builders come to mind that are already up here, are breaking to new highs. Most stocks are not doing that. You need to see some of those early adopters kind of breaking to new highs to feel good about further upside. Now, one thing to pay attention to, this is looking at the percent of the S&P above their 200-day moving average. It's still just above 60%. And again, not quite updated for today yet, but that's where it has been. We are right at the 50% level of stocks at their 50-day moving average, or above their 50-day moving average. So the S&P is sort of flipping back and forth of its 50-day, and you can see that many S&P members are doing the exact same thing, fluctuating above and below. You'd want to see these remain above 50%, which tells you more stocks than not are able to reclaim that 50-day moving average. I would expect that to come off today as stocks sort of came down a bit. We talked about sentiment in a little detail yesterday in terms of AAII and elsewhere, but overall, this sentiment read from individual investors has certainly remained negative. It's been a very unloved rally according to this survey relative to previous periods. And again, for what it's worth, I think you would want to see, bouncing off of these extreme low levels and starting to see optimism at some point. The fact that we broke to new highs and never really got a decent upswing in bulls versus bears tells you how little, at least that cohort of investors, have been supportive of the recent uptrend. Some ratios to look at very quickly here to wrap up. And first, I would just look at consumer discretionary versus staples. This is a line we've talked about for a little bit. It potentially is building up for a little bit of a base breakout here, which would tell you that this is consumer discretionary versus technology here at the bottom in brown. It's very close to actually breaking to a new swing high, which would tell you finally technology is underperforming consumer discretionary, one of those big themes that has not necessarily been the case. They've essentially been lockstep for quite a while. The world is not as supremely negative as I think it looked as things were coming off of the September high, because certain things have been alleviated. One thing that has remained relatively positive is the relative performance of semiconductors, and we'll stop it here. I think that's one chart to certainly continue to follow. In general, when that group does well, it's a bellwether group. If that group's doing well, it's hard to think that things could get that bad, because this is a central part of how most of us are living our lives right now. So strength in semiconductors continuing through the end of this week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.